Affordable housing isn't just a McPherson story, it's a Kansas story. From McPherson County to communities across the state, safe, stable homes are essential for thriving families. At the McPherson Housing Coalition, we're developing emergency shelters like the Oak Harbor Cottages and building permanent supportive homes through projects such as Sutherland Estates, creating housing that includes wraparound care and services. If you believe every Kansan deserves a place to call home, your support matters, whether you're in McPherson or miles away. Learn how you can help listeners and neighbors across Kansas by visiting McPhersonHousingCoalition.org.
Welcome to Housing for Good, a podcast dedicated to housing topics and issues affecting our communities in McPherson County and beyond. With years of experience and expertise, hosts Chris Goodson and Carolyn Moore discuss housing challenges and opportunities with other experts from a variety of housing fields.
Hello, and welcome to another episode of Housing for Good. I'm your host, Chris Goodson. On this podcast, we talk about all things housing, challenges, solutions, and stories that shape how we live and build community. Today, we're talking about one of the most important and sometimes intimidating parts of home ownership, home loans. Let's be honest, the paperwork, the terms, the numbers, it can feel like learning a new language. But the truth is, mortgages are what make home ownership possible for most families. That's why I'm excited to have Kenan Warren from Farmer State Bank with us today. Together, we're going to break down the basics, answer some of the most common questions, and hopefully make the process a little less scary and a lot more empowering. So let's go. So first thing, to kick things off, Kenan, welcome.
Thank you.
Yeah, and so give us a little bit of background maybe about what you do at the bank or how you got into this business, or tell us about it.
We're a small bank, small institution, so everybody wears many hats. We do a lot of things, but my main focus is lending and a lot of home lending. Me and one other gentleman at the bank do probably 90% of our home loans. At our bank, Zach and I don't always just focus on home loans. We do all sorts of types of loans. What I typically tell people is I do all types of loans except for agricultural loans. I'm not an ag banker.
You're not an ag guy?
I'm not. That's a whole nother world. In my opinion, you need to grow up on a farm to be an ag lender.
That's a good one.
That world is a whole beast of its own. But so yeah, I specialize mostly in home lending, consumer lending, commercial lending, everything outside of ag.
So what I love, it's really is a family bank.
It definitely is.
It was a family. Did your family start the bank?
My grandparents bought the bank in 1972. At the time, they had a business partner. Bob Richter was his name. So they bought it together in 72, and they actually borrowed money from UMB Bank to buy the bank.
Oh, wow.
So at that time, when UMB loaned my grandparents the money and Bob the money to buy it, one of their contingencies is that they wanted the loan officer from UMB to be on our board.
Oh, okay.
And so Dick Renfro, who worked for UMB his whole life, or most of his life, was on our board until he passed away here a few years ago. And him and my grandpa became really, really good friends. Yeah, it's an interesting story. And then in 1977, my grandparents bought out Bob Richter, and so they owned it. And then I'm trying to remember the year my Uncle Jeff came back and started working at the bank. I believe around that same time, like 1976, 1977, my Uncle Jeff came back and worked for the bank full time. And then my dad started in 1989, and that was the time or the year that we branched into McPherson from Galva. Then in the early 90s, my grandpa and his sons, my dad and uncle, there was a standalone bank, Fallon State Bank in Fallon, Kansas, and they bought that charter. So banks have charters, and they're kind of difficult to get. So the easiest way to get one is buy one, because starting a bank is extremely difficult. Between paperwork that you have to put together, and then you got to raise a lot of capital. But they actually ended up closing that bank in Fallon and moving it to Lindsborg. And then in 2004, we opened our North Main location here in McPherson. So we have 4 locations now. That's how we came to become
Oh, wow.
4
That's
locations.
awesome. So, I love that. I love that whole story about the family. And I know most of your family.
Yeah.
So, yeah.
My grandma passed away a few years ago, but my grandpa's still alive.
Yeah, that is such a cool story.
He still goes into the bank every day and has an office and bugs people.
But, and that's probably what keeps him going, quite honestly. Yeah. Sometimes if we let our older people, they have a lot of wisdom, and if we let them continue to work, they can teach us a lot. Yeah. So to kick things off, let's start with the basics. What type of home loans do you offer?
For the most part, we offer just conventional home loans. We have avenues to do the government loans, FHA, RD, VA, but those are extremely tougher to get them to the closing because of the requirements around them. So we don't directly originate those. We do conventional loans. If we can sell the loan, it's a conventional loan, and that we kind of just have one program for that. If we end up having to hold the loan on our books, that's a possibility, but it's not as attractive to a borrower because the down payment percentage is more. It's 10% on those loans that we can't sell. And then typically we set those up on a 5 or 7 year balloon payment.
Oh, wow. Okay.
And the reason being is because we can't fix our deposit rates for 30 years, so we can't hold a 30-year fixed rate mortgage on our books. But by selling them, and we sell only to Federal Home Loan Bank, by selling them, they take that interest rate risk off our books and then pay us a small fee to service the loan. We retain servicing, which people like.
Yeah.
A lot of times you hear people, they get a home loan, it's sold 3 different times in 4 years, and they just get a letter saying you now send your payment here. If you have any questions, you got to call this number, and you end up talking to somebody in New York or
it's not
Washington State or wherever it was sold to, and they don't know who in the world they're talking to.
And if you have a problem, you can walk right over to the bank.
Correct.
And talk about it.
Yeah,
right.
Correct.
I mean, they probably feel like they know you. It's a family business, and even the people that are working in the bank are locally known,
right.
So it's not some stranger you're talking to on a phone. I mean, that's a good benefit to a smaller bank is keeping those loans and knowing who you're talking to. But so interest rates are a big one that we hear about all the time. So what are rates looking like right now?
Right now, like I looked this morning in preparation for that question. They vary from right now. If we can sell a loan, they vary from 5.75% to probably 6.75%, and that range is really based on your term, whether it's a 15, 20, or 30-year mortgage. The shorter the mortgage term is, the better rate you get, or the lower the rate is. Now, what they've done, at least what Federal Home Loan Bank's done in the last couple of years, is they've had tiered pricing based on your loan amount. And the reason that is because the less your mortgage amount is, the less likely you are to refinance if rates go down by, say, only 0.5% or a full percent. Because the general rule of thumb is if you have a $200,000 mortgage, if you're going to refinance and pay closing costs and pay all those fees to go through that process, you've got to at least better your interest rate by a whole percentage for that to make sense.
Oh, that's good for people to know. That's really good for people to know.
But if you have a $400,000 mortgage or $500,000 or $600,000 mortgage, if you can save 0.5%, it's a lot more beneficial to you to refinance. So actually, the larger your loan amount is anymore, the higher your rate is because you're more apt to refinance if rates go down at all.
Wow, I didn't know that.
So they actually have tiered pricing to give people a better reason if you have a $200,000 mortgage, which is probably, I don't know the data, but probably the average for our area, I would guess. I don't know, but but just in that portfolio of loans that we have, that's probably really close to the average. If you have a $200,000 mortgage, right now you could get 6.5% on 30 years today. But if, like I said, if you owe more than that, if you owe, think the break's at 275. If you owe more than 275, your rate's going to be closer to 7.
People do not have any idea what rates used to be. When I bought my first house, I was 19 years old. I think I had a 13% or higher interest rate.
Wow.
I would have died for an interest rate of 5%, right? I mean, so that's still a good rate. And would you still encourage people to go ahead and buy their first house or do all those things?
100%.
Yeah.
The last, I'd say now 17 years since the financial crisis, when rates took to zero, essentially, and you could go get a mortgage for 2 or 3%.
Yeah, I had one of those.
Yeah, that's not normal.
Yeah.
But the problem was it lasted so long that it became normal.
Yes.
And now that rates have increased, people my age and younger think a 6% mortgage is just unbelievable.
I know.
But what you just said, people, their first mortgage was.
Luckily for me, I didn't have a very expensive house at the time, so it wasn't that bad. I had a very reasonable payment every single month, and I could afford it as a single parent at the time. But when we did that, I got this rate was unbelievable, but I didn't know any better.
No.
I mean, I had no idea that.
No. Now you could go down a rabbit hole with that, and the thing is though is that I think if you look at national standards and such, that that the income to the price of house ratio was a lot better back then.
True.
So you could get a 13% mortgage and you had money to pay extra on it back. It was easier then.
I probably did not at the time.
Yeah, I'm not everybody, but
but yes, you're right.
Yeah.
You're right. It would have been a much better situation than it is.
And your debt to income ratio, it still looked okay.
Yeah.
But I think that's why we're here, is because we're talking about housing shortage. In theory, when rates go up, the value of homes, in theory, is supposed to go down because it becomes more expensive to buy that home or a home. But when our supply is so far behind our demand, that obviously hasn't happened.
No, I haven't. As an appraiser, I have not seen that.
No.
I mean, sometimes I'll appraise something and go, this house just sold for what?
Mm-hmm.
And I do this every single day. I'm out there every day looking at houses, appraising, and my mind is blown about what property still is selling for, even stuff that I probably would think twice about buying or living in. I'm like, this sold what? Mm-hmm. It's mind-boggling. And
then things happen like COVID, and it just goes even crazier. It goes gangbusters.
Yes.
I mean, people are, because rates went back down to nothing.
Yeah.
And all of a sudden people could afford to upgrade their home and get a bigger house. And
yeah, we were appraising 8 weeks out at one point, which is crazy.
Yeah.
I've never been 8 weeks out in my 25, almost 30 years or however long I've been doing this. I'm like, what?
Yeah.
Wow. I wish like to have that money again. Right?
It was a busy time.
It was awesome. Yeah, we were loving it or whatever. Okay, so when people shop for loans, they often are faced with the question, do I go with a fixed rate or adjustable rate? Do you work with the fixed or adjustable rates at all in the bank?
We don't make adjustable loans on primary residence loans. Now, we have quite a few customers we consider them commercial customers because we have quite a few customers that are landlords. They have rentals, and some of them have 10, 20, 30, 40 rental houses. We can't fix those. I've looked at a product through Federal Home Loan Bank where we could sell those loans to them and fix them, but there's downfalls to them. Not downfalls, I guess, but they limit, like you can only sell 4 or 5 properties into that product. It requires cash down payment and closing costs, whereas a lot of times our rental customers that have 20 rentals, they've paid them down enough where they don't want to put more cash into their next purchase. They want to borrow against their equity on their 10 or 20 other rentals to buy another one. They just want to borrow all the money. And they're in a spot that we're willing to do that because they've paid down and have good equity in what they have. But those are adjustable rate mortgages, but on a primary residence loan, we don't make adjustable rate mortgages.
Okay. And there would be no benefit. Do you think there'd be a benefit to that?
The only time there's a benefit is actually if you are buying in a time that you think that interest rates are going to go down in the near future. So if you buy a house right now and say the Fed does cut rates over the next year or so, and in turn your rate goes down, that was a pretty good deal in the short term. But it's going to adjust too if they go back up.
Right.
So
that's kind of risky. It's like playing the market or gambling a little.
Yeah, it's a riskier game than getting a fixed rate mortgage.
So here's something everybody wants to know is how much money do I need for a down payment? Does it depend on how good my credit is? It depend on the type of the house? What are we looking at with that down payment? Because that's really important to people that are buying that first house. Is what does that need to look like?
So if we're selling the loan, the minimum down payment percentage you got to come up with is 5%. And that's 5% of your purchase price.
Oh, I thought it was way more than that. I thought it was like 20% or something.
To avoid mortgage insurance, you got to have 20% down.
Okay.
So if you can, now we always tell people, if you can get to that 20% and avoid mortgage insurance, that's the best thing for the consumer or the customer, because that mortgage insurance does absolutely nothing for you as a borrower. What that does is protect the owner of your loan against default. So if you default and they have to sell the house and they have to sell it for less what you owe against it, they're going to make a claim on that mortgage insurance that you've been paying for them.
So if I'm a person who maybe is a low-income person, but I've been able to build my credit up, I really don't, 5%, I mean, they're still going to pay that PMI, but that's a way to get into a house. And it
100%.
may end up being, I mean, I see people paying way more for rent than I've ever paid on a mortgage. Now, granted, I've been in my house forever, but I mean, some of the rents that I see right now are unbelievable. And so if they could figure out a way to buy that house and take care of it, which is the other part people don't consider, is if the roof goes bad, the hot water heater goes out, you have to be responsible. But man, that's really a good deal. I thought it was automatically 20%, and I learn something every time I'm on this show. It's like, wow. And I don't tell people these things. I'm just thinking in my mind because I'm not the expert with loans or whatever. People think appraisers know all this stuff. I was like, nope, that's not my thing. I just do the appraisal, try to tell them what it's worth, and move on or whatever. So that's really good. So so when we look at buying the house, what kind of closing fees and all that type of stuff are they looking at typically? Because you have to pay for that up front when you buy the house.
And that really ranges on the amount you are borrowing. Well, some of those fees do. Your biggest fees, like your title work, is really driven on how much you're borrowing and how much you're purchasing. Our origination fees are flat, regardless of the loan amount, but there's a lot of bigger lenders out there that they're charging you a percentage of what you're borrowing as an upfront loan origination fee.
Oh.
You know, I always tell people, if you're a local person with the means to buy a home, I don't know why we got other good local banks in town too, why you wouldn't deal with us or another local bank, because they're all the same. I know, I've seen their fees. They're comparable to ours in the fact that it's a flat rate fee.
So that's like a hidden fee that maybe you weren't prepared for.
Yeah. I mean, it's not, they got to disclose it. It's not going to be hidden, but it's substantially more than, like, we charge for a purchase, we charge a flat $800.
Yeah.
Whether you're borrowing $100,000, $200,000, or $600,000.
Yeah. I don't mean hidden. I mean like something you're not prepared for.
Yeah.
Something that you're not, when you're trying to do your budget, you don't consider that.
Yeah. So typically your closing costs, so there's two different things actually what you have to come up with is your closing costs and then your prepaids. Your closing costs are going to be $3,000 to $5,000, but on top of that, your prepaids can be another $3,000 to $5,000. And what make up those prepaids is your first year's insurance premium. This goes back to, again, if you have 20% down, you don't have to escrow your taxes and insurance with most loan products. If you have less than 20%, you almost have to escrow your taxes and insurance with your lender or the person that's going to be servicing your loan. And again, that's a protection for the bank and sometimes the consumer. Some people want it because that's just one less bill it's in their monthly budget. They know that's what they got to pay. How do I explain that better? It's not really a benefit to the customer outside of the fact that you don't have to write those bills out when taxes and your insurance are due. So
even though it's not a benefit, is there anything added on to their bill because the bank is covering that?
No.
Okay. So
you can't charge for it.
Okay. So they're not really losing anything.
No.
They're just letting you take care of that for them.
Right.
I think it is a shock. I know somebody that paid off their house and then they realized, oh my goodness, I have to pay this taxes and insurance myself. Oh, I never had to do this before.
And we've had people ask us that before. Like they've paid off their mortgage and they say, well, are you going to keep paying our taxes? Well, no, we don't have your escrow account anymore. That's your job now. Well, is there a way you could? No.
No, there's no way that I can. No, we don't want to. No one wants this or whatever. Okay, so let's get into credit scores a little bit. What does that look like? That affects the interest rate you get? Is that right?
Well, long story short, yes. So on these conventional rate loans we make, the minimum credit score you have to even qualify is 620. I know there's other and this again, I don't make these loans, but like the government FHA, VA, RD loans, I think they're maybe it's like 580, and that maybe just be FHA. But again, this goes back to maybe like a big bank or big mortgage lender compared to your smaller hometown banks, is that we don't have a pricing matrix that we're, okay, this is your debt to income, this is your credit score, blah, 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 this is the rate you get. If you qualify, we're pricing it to try and make the same percentage off of your loan when we sell it as the next person. Whereas a big lender, they do have a risk matrix. So if you have a 640 credit score, which isn't terrible, but it's not real good either, and maybe a little bit higher debt to income ratio, they're going to charge you a bigger rate because they look at that loan as riskier than somebody that has an 800 credit score and a lower debt to income ratio. So that person over here is going to get a better rate than that first person is.
So when you talk to loan to value ratio, what is that exactly?
It's kind of the inverse percentage of what you put down. So if you put down 5%, your loan to value ratio is 95%. If you put down 20%, your loan to value ratio is 80%.
Okay.
And that is the amount you're borrowing divided by the value of the home. Now, in a purchase transaction, sometimes people say, well, I'm buying this for $200,000, but I really think it's worth $250,000. Well,
I never hear that as an appraiser.
If you were buying it for $200,000, why is it, explain that to me. But there are certain instances, and we see this sometimes with family members, a grandparent might sell a house to a grandkid or whatever for well below what it is actually worth.
Yeah.
But when we're selling that loan, the loan to value ratio is based off of the lesser of the sales price or the appraised value. So if you're buying something for $200,000, but it is actually maybe worth $300,000 because your family member's selling it to you, we have to use that $200,000 as really the value. It trumps the appraised value.
Oh, really?
When we sell the loan. Now, there are ways around that. I mean, we've helped explain to people, you can put on paper you're buying it for $300,000, but I'm gifting them $100,000 of equity. But that opens a can of worms with taxes. So what we always say, if you're going to do this, you need to talk to your CPA or the person that prepares your tax returns, because that's over the IRS gift limit that you can give somebody in a given year. And then it might be taxable income to that person that received it, when that's not what you're intending or wanting to do.
So yeah, it's like someone's always got to be in the middle of your business,
exactly.
Don't they? I'm just trying to give my kids something. And
they're going to get it anyways.
I know. When I do an appraisal, I do make a notation if somebody says, hey, it's my kid, and I'll say, well, would you have sold it to me? I always say, would you have sold that house to me at the same price that you sold it to them? And if they say no, then I look at that a little closer to say, wait a minute, And then sometimes they say, I'm giving my family member a deal, and I'm like, well, I don't think so.
It doesn't seem
it doesn't seem like it, but I don't say that too loud, or I don't tell them a lot. I just have a lot of things going on in my my head or whatever. Okay, so let's get real about your mortgage. Let's say I miss a payment, or I'm behind, or I've had a family emergency. I mean, how quickly should I come in? What does that look like? I feel like that what happens to a lot of people is they get behind and they're embarrassed. They think they can catch it up, and then they can't. I mean, what's the scenario there? How do we help them?
They need to come in or contact their lender as soon as possible. If they now, you don't always know, but most of the time people know when you are balancing your checkbook or doing your budget or doing whatever you do to pay your bills. If something's happened and wow, I don't know if I'm going to be able to make my house payment this month, you need to start early, because there are things that banks can do to try and help you. And there's organizations out there that do things to help, I think even homeowners, but I know renters. But the main thing is you want to get in there early as possible, because missing a payment, being late on a payment is different than once you get to 30 days late. Once you get 30 days late or more, that's when it dings your credit and really starts to hurt your credit score. As long as you make it in that given month that it's due. Now, you might have a late charge on there if you get past 10 or 15 days, but that doesn't even report to the credit bureaus. They don't know you were even a little bit late.
So like 29 days or something, 28 days, try to get it into that period if you possibly can.
But give your lender time. Give them a heads up and see what options or thoughts that they have on trying to help you before. Don't wait till the 29th day.
Well, I know. I was thinking about making the payment. Not that other part. But, life happens.
Exactly.
People get sick. People pass away. I know in our family, my husband, he pays our bills out of our checkbook, but I don't even do that.
Yeah.
So I would take care of it, obviously, but, it might take me a minute to catch back up. And, and that could be the case for a lot of people, sometimes the wife, sometimes the husband. And so it's like, well, we have to make sure that, if something happens, make sure you tell your bank.
Right.
Hey, I've had this situation. I'm sick. I'm in the hospital. Somebody passed away.
Yeah.
I lost my job. I mean, there could be a million different things as to why that's happening. So, just be really open and honest. I feel like that's what you're saying is come in. That's what's great about these local banks, right? Because you know them. They're not strangers. They
want to work it out for you.
Yeah, and I feel like that you really care about your customers. Right.
And even the large banks don't want to repossess anything. We make money by getting payments. We don't make money by repossessing assets. That's not what we want.
Yeah.
That's last resort stuff.
So how hard is it to refinance? Is that a pretty easy process? We talked about it a little bit, being able to refinance, and that's this percentage. If you're, I don't know, you were talking about that a little bit. So what does that look like for somebody that just come in and say, hey, I have this mortgage. I see the rates are down a little bit. I want to refinance. What does that look like?
It's very similar to maybe even just having the conversation. If you're not a homeowner, I mean, you just contact us, apply online, do something like that, reach out to us, come in, and really just start talking about your situation. We're going to need income documentation. We're going to have questions about your current home and what your plans are, why you're trying to refinance. Because sometimes people, they want to refinance, but they really they don't want to get any money out of their home or do anything like that. They think they want to refinance to save money. And sometimes if they have a small balance and they're not going to save enough money, that's what we tell them. You're going to spend more. This isn't going to save you money. That's not a good plan, because it goes back to, if you only owe $50,000 on your house and you think you're going to save a bunch of money by cutting your interest rate by 0.5%, you're really not.
Yeah.
Because you're going to pay that interest that you're going to save in closing costs.
So what else? What are we missing? What have we not talked about? Was there anything you can think of? I mean, I feel like we covered a lot. Credit, if you're behind on your mortgage, how to buy a house, refinancing, all the different things. Is there anything else that you want to say that we've covered?
The first thing that comes to my mind is probably people's debt to income ratio. Besides credit score, that's the main key factor on whether you even qualify for a mortgage or not. And how we have to calculate that is we take your gross income, and then we got to pull your credit report, and whatever payments you have on there and whatever payments you have, we have to calculate a debt to income ratio on a monthly basis. For most conventional loan products, if that's more than 43%, you don't qualify. So I usually try and tell young people that aren't a homeowner yet, don't go buy a boat, don't go buy a camper, don't go buy 5 toys, and then go try and buy a house, because it's most likely not going to work.
Get your house first.
Yeah, get your house first.
Get your house first.
Get in a good spot.
Yeah.
And then if you want 1 toy, maybe.
That sounds like a banker talking to me.
I'm a conservative banker.
Yes, you were. And you were raised probably by very conservative bankers. So that would be, So, but I do think that's good advice. Yeah. Everybody wants what their parents have without waiting for the time to get it. They want it right now.
We're seeing that a lot right now. People's first home, they want what their parents have. And I try and tell people you need to buy something, borrow an amount of money that you can hopefully pay back a lot quicker than 15, 20, or 30 years.
Yeah.
Get a lot of equity in your first home, and then buy a nicer home, because then you're going to be able to sell your house, hopefully almost either have it paid for or almost paid for, but you're going to have a lot of equity to put down on the next loan and not borrow as much money. The payment's going to be less. It's going to be more doable.
Yeah.
A lot of people, it goes back to it. People, I don't want to sound like I'm picking on like a generation.
Like your generation.
Like my generation.
I want to make that perfectly clear.
But I am a little bit. I mean, but I'm not. I think it's always been this way. I mean, but it has gotten more difficult because there are less and less affordable homes that are in decent enough shape for someone to even want to live in. I mean, that sounds bad.
No,
but,
I get it.
I mean,
Yeah, I get it. Some of them are pretty bad.
I mean, I got lucky. My first house I bought in town, I bought it for $72,500. You can go buy a car for more than that now.
Yes, you can.
But now I got a good deal on it, but I put more money into it. I mean, I replaced the windows. I did things to try and help my resale value, and it did. But those houses are harder to come by anymore. It seems like that house now probably could sell for $130,000. I mean, it's crazy, and it's been less than 10 years.
Well, and the other part about that is if you don't have skills that you yourself know how, or you have family members. In our family, that's what our kids did. They bought houses that needed work, and they put a ton of work into it. Now they have lots of equity in their properties. But
if you have to pay somebody to do all that stuff,
exactly,
it's very expensive.
Yes, that's exactly right. And my husband's extremely handy, so he helped them do whatever was necessary on their house and saved tons of money.
Yeah.
But not everybody has that luxury.
Yeah. Yeah. No, for sure.
So anyways, that was really, really good. It's been a really informative conversation. Thank you, Kenan, for coming on. It's a very complicated subject, but I feel like you broke it down pretty well for people that are listening so that they have an idea. And, go to your local banks, talk to your local people about, borrowing money and the things that you need to do. I feel like that's probably the best way to go because they're going to have your best interest at heart. It's a more personal relationship if that's what makes you feel more comfortable. For our listeners, remember this, buying a home is a huge step, but you don't have to go into it blindly. The more you understand about your loan options, the better decisions you can make for yourself and your family. If you want to learn more about the process for housing and community support, visit us online at McPhersonHousingCoalition.org. You can contact Kenan at what's your contact information? I'm at Farmers State Bank at 2074 East Kansas here in McPherson. The phone number is 620-241-3090. Okay, that's it for this episode of Housing for Good. I'm Chris Goodson. If you would be interested or know someone who would be interested in being on Housing for Good, drop us a line. Please leave a review at housingforgood@mcphersonhc.org and have a great day.